In this video, we're going to talk about Mullen Automotive, trading under the ticker symbol MULN. At the moment, there's a lot of volatilities coming out of the financial market, and we should be careful about which stocks to pick. This video will cover the recent price action momentums and the technicals of the stock. I will also give my personal opinion about if you should buy, hold, or sell Mullen Automotive. Before the video begins, just a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock increased to $1.03 before closing the trading day at around 89 cents. We should pay attention to the 88 cents level nearby because it was tested multiple times as a support level before, making it a significant level to watch out for. Over the past 30 days, the trend of the stock has been bullish because it increased from around 80 cents level and peaked at almost 4 times where it was, and since then maintained a fairly high baseline in the subsequent days. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock is actually ranging between two very far away amounts, between the penny stock level and around $16 in its peaks. The title is obviously very volatile, and right now, I think that it is likely near a very low point in its overall fluctuations. When we look at the price trend overall, it has been continuing to demonstrate its willingness to bounce between two values, even though at the moment, the stock seems to have oversold and gone lower than many of its previous support levels. The trading volume of Mullen Automotive has recently been 144 million shares compared to the average volume of 97 million shares. During the previous 52-week period, its price fluctuated between 52 cents and $15.90. The market cap of Mullen Automotive is currently at $31 million, compared to the enterprise value of $113 million. The difference between the market cap and the enterprise value is the premium that the market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst the market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for many companies. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that a company is able to generate more profit or grow faster than its rivals because it is assumed that it has a better management team, a stronger brand recognition, or bigger online following. It is basically what makes this company unique versus its competitors. It's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount. Since the market cap is often lower than the enterprise value, as the enterprise value, like we said before, includes the value of the goodwill, and is also less reactive than the market cap in very volatile situations. If the company goes to liquidation, however, the goodwill would be gone, and there would be a lot less assets to distribute than what we think there is on the balance sheet at the moment. When we compare the current price to its historical price fluctuations, the stock is 80% higher than the 1-month low, 80% higher than the 3-month low, and 80% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to go, the implied volatility here is 326% versus a historical volatility of 336%. The put-call volume ratio is currently at 0.16. It's normal for most stocks to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 22,000 contracts a day versus the 30-day average of 11,000. Regarding the open interest, the most recent volume of open interest has been 57,000 contracts versus the 30-day average of 15,000 contracts. In terms of its shareholder structure, institutional shareholders own about 4% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. It is relevant to understand the shareholder composition of a company because it may help us to determine if the stock should be held long-term or to be considered as a trade opportunity. If the stock is mainly held by retail traders, it can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, this is subject to a lot of exceptions since there are many great companies also mostly held by retail investors. But this is so far the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes when there are significant short interest in the total volume, this is a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 5% of the total float and 60% of the dark pool transactions. Overall, my opinion on Mullen Automotive is bullish because Mullen is trading at a very low level compared to its historical tendencies over the years. And the EV sector has always been a very volatile situation, providing a lot of opportunities. And if we have a very good entry point, this can be the beginning of a great ride. The maximum exposure I would recommend is 1 to 3% of your portfolio. For the immediate term, my recommendation is to buy the stock considering the recent price actions and promising price levels that are very close to where the stock is at the moment. I would recommend to separate the allocation in batches of 25% at a time so that you can have enough room for later purchases should the stock correct even lower. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.